Good afternoon to everybody. I'm Brian Pascoe, the Chief Executive of ICMA. On behalf of the International Capital Market Association, ICMA, I welcome you to this virtual event to launch our new report, Asian International Bond Markets, Development and Trends. Asian bond markets are of keen interest to ICMA, which represents the global debt capital market with a diverse membership that includes private and public sector issuers, banks and securities dealers, asset and fund managers, insurance companies, law firms, capital market infrastructure players, and central banks. With over 600 member firms in 65 jurisdictions and close to 80 member firms in Asia alone, supported by our Hong Kong office, which we established nearly a decade ago, we are the leading trade association in the fixed income space. Through our expert forums, we focus on market practice and regulatory policy issues across primary and secondary bond markets and repo, where two themes have become key priorities for ICMA members in the last 2 or 3 years: sustainable finance and fintech, both of which are touched on in this report. We are very aware of the spectacular growth of the Asian bond markets, but our headline statistics drive this home. Annual issuance of cross-border bonds from Asia has increased sixfold over the last decade and a half, from $107 billion equivalent in 2006 to $614 billion in 2021. Having personally been directly involved in the evolution of the Asian debt capital markets for over 25 years, it gives me great pleasure to see the level of maturity that has been reached and achieved. Before I get into the report itself, I would like to thank the organizations who helped us with this project. First and foremost, of course, we are extremely grateful to the HKMA for their continued support, as well as the initial inspiration and scoping for the research. We would also like to thank our data partners, Dealogic, Bloomberg, Equilend, IHS Markit, and Market Access, all of whom generously shared not only their market data, but also their time and expertise. Now, let me share just a few conclusions from our data analysis and market interviews. Our new report covers both primary and secondary markets across Asia, including China, India, Japan, ASEAN, and South Korea. Looking at the primary markets first, Asian financial centers are playing an ever larger role in arrangement and listings, and Asian issuers have become more and more active in international bonds from Asian issuers, which only a decade ago were distributed mostly to investors outside of the region. Chinese issuers now account for 37% of total international primary market volume in Asia, from a very low base 15 years ago. And in the sustainable space, sustainable bonds have also gained traction in the international Asian bond markets, almost tripling in annual issuance from 37 billion in 2020 to 99 billion in 2021. Notably, sustainable issuance accounted for 16% of Asian international bonds in 2021, which compares very favorably with 11% across global markets. Turning to the secondary markets, the data suggests a more active secondary market in 2021 compared with previous years, both in terms of trading volumes and the number of transactions. Our interviews suggest that secondary market liquidity is indeed improving, at least in the investment grade space. On the other hand, CDS and repo markets in Asia are often inadequate to support liquidity and hedging, particularly in the high yield space. Across the region, electronification of markets continues. Platform-based trading continued to gain momentum over the past 12 months, mainly driven by efficiency considerations. The report goes into far more detail on all of these topics, and we welcome your feedback on our analysis and any ideas for further research. More broadly, I should also point out ICMA has recently published a number of other market guides relevant to Asian markets. These would include a handbook for investing in China's interbank bond market, a guide to the Japanese repo market, which is one of a number of domestic market repo reports that we will be coming out with this year, and also a guide to LIBOR transition and tough legacy bonds in the Asia-Pacific region. All of these, as well as a number of reports on the sustainable finance space, can be found on the ICMA website. I will conclude here. Look forward to an engaging panel and hearing the perspectives of all of our distinguished speakers and panelists. And with that, I would like now to hand the floor to Mr. Daryl Chan, the Executive Director External of the Hong Kong Monetary Authority.
Brian, Distinguished guests, ladies and gentlemen, good afternoon and good morning. Let me first thank ICMA for the invitation. It's indeed my great pleasure to speak to you today. On behalf of the Hong Kong Monetary Authority, I would like to congratulate ICMA on the publication of this important and insightful report on Asia's international bond markets. This is the second year that ICMA published this report. Bond market data are relatively difficult to come by due to the OTC nature of the market. The report fills the gap by collating and organizing the data in a meaningful way. It helps market participants and policymakers better understand the industry's state of play. In the case of the HKMA, the first edition of this report has been a valuable reference that helps us analyze bond market dynamics and develop policy recommendations to promote Hong Kong's bond platform. We trust that many market participants have also benefited a great deal from the report. We are therefore glad to see the release of the second edition earlier this week. And we are also honored to be able to support ICMA's preparation of the report. 2021 was a challenging year. The global bond market faced headwinds such as the ongoing pandemic and the prospect of tightening monetary conditions. Here in Asia, however, the market continued to see healthy growth. The report noted that the annual issuance in the Asian international bond markets reached a record level of more than $600 billion in 2021. In particular, Chinese issuance accounted for around 40% of the international issuance volume in Asia and remained a major source of growth in the region. This presented immense opportunities to international investors looking to diversify their portfolios and gain exposure to Chinese credits. It also generated lots of business opportunities for debt capital market service providers that have the expertise and network to support Chinese issuers. We're glad to see that Hong Kong continued to be the location of choice for Chinese offshore issuance. This was one of the key factors that underpinned Hong Kong's position as the #1 arranging hub for all Asian international issuance for 6 consecutive years. We also applaud ICMA's effort in expanding the report coverage this year to include green and sustainable bonds. In Asia, this segment has seen a remarkable threefold increase year on year and reached nearly $100 billion last year. Many of these bonds follow ICMA's internationally recognized principles, from the first green bond principles in 2014 to an ever-expanding suite, now covering also social bonds, sustainability bonds, and sustainability-linked bonds. We are encouraged to note from the report that Hong Kong was the largest arranging hub of Asia's green and sustainable bond issuance. The strong fundamentals of the Hong Kong bond market have played a critical role. But equally important is the proactive policies and measures adopted by the Hong Kong government and financial regulators to facilitate market development. These include a structured and reputable government green bond program, a subsidy scheme, as well as cross-sectoral efforts to promote the availability of talents and data. Apart from primary issuance, the report also offered insight into the secondary bond markets. Multiple factors are changing the dynamics of secondary bond trading. One obvious example is the adoption of new technology, such as electronic trading, as mentioned by Brian just now, or even blockchain that promise better transparency and efficiencies. Here in Hong Kong, another exciting breakthrough in the past year was the launch of the Southbound Bond Connect that opened up a convenient channel for mainland institutional investors to invest in offshore bonds through the Hong Kong platform. With all these new developments, we are confident that we should be seeing increasing secondary bond market activities in the years to come. Looking ahead, 3 months into 2022, the year has already promised to be eventful, with heightened geopolitical tensions and the first rate hike by the US Fed in more than 3 years. Come what may, the market will continue to move ahead, and we should always keep improving our offerings. In Hong Kong, the central money markets unit is undergoing an overhaul. The objective is to develop the CMU as an international central securities depository in Asia. We're also working to put into use a tokenized green bond prototype that we co-developed with the Hong Kong Center of the Bank for International Settlements Innovation Hub. Meanwhile, the Hong Kong government has completed a review of the Hong Kong bond market and will put forward a number of recommendations to support the continued growth of the primary and secondary markets. So stay tuned. I'm sure that many of our audience today are likewise working on something exciting. And let's hope that this time next year, we will be celebrating another productive year for the Asian international bond markets. Once again, thank you, ICMA, and congratulations on the launch of the report. I wish you all a most fruitful and inspiring event. Thank you.
Thank you, Mr. Chan. This is Mushtaq Kapasi. I'm Chief Representative for Asia Pacific for the International Capital Market Association. And now we will move on to our panel discussion. We have a very impressive lineup of speakers, each of whom have deep experience in the Asian international bond markets over many years. But what I like about this panel is that each of our speakers today comes from a slightly different angle, whether it be primary, whether it be secondary, and from different geographies. So we're looking forward to hearing the different stories and perspectives that each of the panelists have to say today, along the themes that we discuss in the report. But before we get into the panel discussion, what we'd like to do is give the audience and the delegates a bit of a taste of the research that we have undertaken and of some of the findings that we have in the report. This will give some background for further discussion. This is the overall snapshot of the evolution of the Asian international bond markets, and it demonstrates the incredible growth over the last 15 years. One thing I should just clarify is that this covers international issuance, which is defined by issues that are sold in a market outside the issuer's home jurisdiction in the Euro market or globally. We also are talking about Asia here, so it excludes Australia and New Zealand, but includes Japan. And if you look at the chart, I think the main story to tell here are the green bars that are virtually non-existent in 2006, but have grown to a large proportion of overall issuance in 2020 and 2021. That would be issuance from China. Now, this slide shows not overall issuance year by year, but debut international bond issuance in Asia by deal nationality. This means these are issuers that are actually new to the international market in a particular year, and it shows the amount of issuance. So this graph, unlike the previous one, shows the quantum of growth, shows the speed of growth in some way. And again, what we are seeing is that the growth in Asian international bond markets is largely driven by Chinese issuers. However, I think you'll notice that the bars are not just one color. There are actually a wide range of issuers across Asia that have been entering the markets year after year. And although the volumes may be largest for China, we're seeing a great increase in diversity of issuers. What this means is that the growth in the markets has not been driven merely by existing issuers issuing in larger volumes, but by the entrance of many new issuers every year over the past few years, which is resulting in a deeper, more diverse, and I would say more interesting market. One quick note here, it's a little bit hard to see from the slide, but in 2021, we've actually seen a quite significant entrance of debut Indian issuers as well. And this would be an interesting trend to watch in future years. Now, this is in a way my favorite slide because sustainability is close to my heart. And I think the headline statistic here is one that Brian touched upon as well in his opening remarks. If you look at the lower right-hand side, you look at the global average for sustainable issuance as a proportion of overall issuance. And when I say sustainable issuance, I mean green, social, and sustainability bonds as defined by environmental finance. If you look at sustainable issuance over overall issuance, it's 11% globally, whereas in Asia, it's 16%. And you can look at some of the countries where the percentages are even higher. So for example, in China, 17% of international issuance is actually sustainable issuance. And in India and Vietnam, the proportion is even more astonishing, even though the volumes are slightly lower. What this shows to me is that when Asian issuers are looking to go internationally, they're also thinking sustainably, and they're recognizing that international investors find sustainability very important, and they're very much on the track to sustainability. It's an absolutely good trend, and we look forward to this continuing as well. When I was looking at the markets, even 3 or 4 years ago, sustainable issuance was a tiny percentage of overall issuance, and now that continues to rise and rise until perhaps one day, not so far in the future, we will see sustainable issuance as the de facto norm rather than a separate category that we have to look at. So that's the taster for the primary issuance portion of our report. I'm going to hand it over to my colleague Andy, who's the co-author of the report, to speak about some of the data we've had on the secondary markets.
Thank you, Mushtaq. This shows trading volumes by country and country of ultimate risk, and also trade count. And if we look at the trade volumes and the number of transactions, what we see very clearly is that secondary market activity has increased in 2021 relative to previous years. And this is consistent with the qualitative feedback from the interviews, which suggests that secondary market liquidity in general seems to be improving, at least in the investment grade space. Participants talk of more balance sheet being put to work on their trading desks, particularly amongst the international banks. Now, reflective of primary markets, Chinese issues tend to dominate secondary market activity, constituting some 50 to 60% of traded volumes, possibly even higher for financials. Participants suggest that China investment grade issuance tends to be the most liquid segment of the secondary market, particularly the financial sector, and especially shorter to intermediate maturities, the investor sweet spot. In terms of other countries of risk, participants report that Republic of Korea and Hong Kong issuance is the next most liquid after China, followed by India, Indonesia, and Singapore. Here we see average trade sizes, and again, you can see that for Chinese financials, this seems to be on an upward trend. Hedging and financing markets, for any intermediated market, the ability for market makers to hedge and finance their trading activity is critical. What we find with respect to CDS, which is the primary hedging instrument for credit, participants confirm adequate liquidity in the index swap market, which provides some more generic hedging of credit risk. However, the single name CDS market for Asia credit remains poor, and this makes it particularly challenging to hedge specific credit risk. And whilst it is possible to find quotes in some of the more active single names, such as those that are in the index, there are still issues with unwinding positions. Now, given the continued growth in the primary bond issuance that we've just seen, and the increase in secondary trading activity, this could be viewed as a critical gap in the Asia international bond market structure. Now, with respect to repo, in credit repo, this includes securities lending. We actually see and hear that market liquidity, at least for investment grade, has been relatively good and improving. And this is really important for market makers to be able to provide offer-side liquidity in bonds that they do not hold in inventory. This is corroborated here by the data which we have from DataLend, and which shows international credit on loan, that is lender to broker. And this is a really good proxy for specific repo activity, i.e. short covering. What we also see, and perhaps not surprisingly, is that on loan balances begin to increase in early 2021, spiking in March 21, with China and Hong Kong credit seeing a notable increase. And this correlates with a widening of Asia credit spreads that starts shortly after that, from around April to May 2021, which we can also see if we move to the final slide, which looks at market performance. And it's important to note, and we made this observation in the previous report, that Asia G3 credit spreads tend to correlate more closely with US credit markets than the underlying local currency markets, with a tendency to underperform in risk-off scenarios. And that assertion holds true in 2021 with Asia credit tracking the general US and global widening trend. But with a higher degree of sensitivity. And this we can potentially attribute to the evergreen default, which raised concerns about the China real estate sector and high yield more generally. But I think we'll explore some of these themes, including the trends in electronic trading in the panel discussion. So I'm going to hand back to you, Mushtaq.
Thank you very much, Andy. And just a reminder that all of the slides you've seen, all the data you've seen, are just a fraction of what we have in our report, which you can find on the resources section here on the event platform or on our website. We'd be very happy to hear your feedback and your ideas for future research on this and your comments on our analysis of the data. So thank you very much, Andy. Now let's get right into the discussion, which is hopefully my favorite part. And first, I will reintroduce the panelists that we have today. So first, we have Ms. Ling Chen, Deputy Head of Global Capital Financing Department of the Industrial and Commercial Bank of China Asia Limited. We have Riyad Chaudhry, Head of Asia Pacific for Market Access. Carla Gooch, Head of Debt Syndicate Asia Pacific at HSBC. Aaron Kwok, Managing Director and Head of Capital Markets, ASEAN, Standard Chartered Bank, and Julian Martin, Managing Director and Head of Emerging Business Development Markets for Hong Kong Exchanges and Clearing Limited. So now that we've set the scene with a few charts, I'd also like to set the scene in a different way by hearing some of the personal stories in the markets of our panelists today, how they have seen the markets evolve from their own perspectives. And I'll start with Ms. Chen.
Yes,
Chen,
thank you. Yeah.
Thank you. Welcome. Could you please share your perspectives on the Asian international primary markets over the last several years, including what are the main trends you've seen in terms of volumes, geography, sector, and issuer types, as well as some of the most important innovations from your perspective?
Yes, I'll be my brief introduction will be focused on the trends and outlook of the China offshore bond market, which is because we are the largest Chinese bank, so we have already done lots of China bond transactions. So in 2021, over 700 international bond issuance from China with a total amount of $224 billion US. So China continued to dominate the Asian international markets, with issuance account for more than 37%, as mentioned previously, of the total market share. Well, the rest of China is seeing good growth in bond issuance. China remains Asia's largest issuer, with issuance nearly 50% higher than the second place, Japan. Although significant credit events from the Chinese real estate industry affect the issuance from the overall sector into the international bond market, which issuance volume from this class of issuer has continued to decline since June 2021. The overall issuance volume for China offshore bonds has remained generally consistent for last 2 years. Besides, we see that Chinese deals as a significant driving force, making up to 63% of all Asian international first-time issuer in last calendar year. So comes to sector and the issuer types, we see that the issuance of IG bond account for 66% of the total issuance, an increase of 2% from the previous year. A few leading companies in subsectors have issued bond in overseas markets for the first time, which have been actively subscribed by overseas investors, further enriching the composition of issuer of Chinese-funded enterprises. So from the perspective of sector distribution, the financial sector dominates the primary issuance market around 40%. The issuance heat of real estate company has reduced significantly, about 26%, while the LGFVs, there were strong refinancing demand and the favorable financing costs brought by the standard letter of credit structure, which has pushed the issuance scale of LGFVs to bottom out in the middle of the year, about 22%. A large proportion of China offshore issuers are mainly real estate LGFVs and financial institutions. But the group of China issuers continue to diversify by sectors since 2018. So, for example, the TMT and the industrial sector has been more active in the primary market. So overall, Chinese issuers are becoming more and more diverse. The proportion of high-quality corporate issuance scale has increased. Comprehensive financing costs have dropped significantly. The effect of serving the real economy has become more obvious. The role of supporting major national strategy and a key area has becoming more prominent. So look into the 2022. Although last year, as mentioned previously, government tightened requirement on leverage rate of real estate companies, some companies failed to meet the requirement and defaulted on offshore market, which causing a brief panic in the real estate sector. This is a self-regulation of the market and will not affect the overall function of the Chinese offshore debt market. In the long run, the Chinese offshore bond market will further mature and improve. Besides, under the downward pressure on Chinese real estate sector, the offshore bond are under pressure and default risk may still exist. Well, on the onshore financial policy on the real estate market has been loosened up lately. The change of policy may bring a marginal recovery trend, but we still need to watch the rise in U.S. Treasury yield, which may tighten the Asian offshore bond market liquidity margin. So overall, Fed policy and inflation will continue to drive IG bond performance in 2022. High yield volatility remains high. As mentioned, with policy measure taking hold for China real estate firms and the rising bond buybacks, the segment may outperform the market. Issuance volume may swing with the U.S. Treasury yield. That's basically my view on 2022. Thank you.
Okay, thank you very much. Really interesting perspectives, and actually 2 points that I took away that I think are maybe not obvious to people who aren't super familiar with the market. One is the increasing diversity of issuers. We hear a lot about real estate and financials, but the fact that issuance is increasing in some of the other more corporate and industrial sectors points to the maturity of the market. And secondly, I think is the importance of global monetary policy in fueling issuance and demand in the international markets out of Asia. It's still very important, and something we'll need to watch in the current situation. Okay, well, let me move on to Aaron now. And Aaron, you are a very long-standing, experienced expert in the Southeast Asian markets. Can you give your perspectives from the sub-region, please?
No, of course. No, thanks very much. I think ASEAN is an interesting little patch. I think we are certainly very diverse in this 10 ASEAN member countries, as well as the 6 major countries where we see most of the issuance is coming out from. But it's an interesting situation because we have one. Very liquid financial institutions that are ready to give loans to corporates. We also have very interestingly built up local capital markets in most of and certainly in the top 6 ASEAN countries, where you have a local currency market available for you, and in varying degrees have developed across the different jurisdictions. So this obviously gives investors as well as issuers choice in terms of where to raise money, and that's been one of the key things that we've seen. Now, when I started in DCM back in 2002, the full year of ASEAN issuance was about 14 billion. It kind of last year it was around 60 billion, and the year before in 2020 was the peak when it was 67 billion of issuance. So obviously, in the past 20 years, it has grown on its own quite significantly. But equally, the local capital markets has grown as well, meaning that, again, more people or more issuers are moving, not only expanding their business, but also moving away from loans into bonds as a means of, stacking their capital structure in a more diverse way. And this is something that we've seen happen certainly in the last decade. Clearly, over the course of the last couple of years in COVID, we did see some interesting developments around in 2020, a lot of corporates as well as financial institutions kind of, rushed to shore up some capital, just in case. We realized that, COVID was taking a long time, loan growth wasn't as great. So, obviously liquidity actually increased in a lot of the banks. And therefore we saw a little bit less of that in 2021. But I think coming into 2022, despite the geopolitical risks that, Brian and has alluded to as well, I think, we are in a situation where we're quite optimistic as to continuing to be able to give our issuers, choice in terms of where they can raise money from very short-term to long-term bonds. I mean, this week is interesting because it's been a couple of months of hiatus of no issuances in the public bond markets, and then this week we've had 3 in a row starting from Monday. So in fact, if I was talking about some of the issuance data from last week, we would have been 60-70% lower than where we were year on year. Now we're like 40%, so we're at 10 billion. And again, if you look at the 10 billion that we are year to date versus the 14.5 that it was 20 years ago, it gives you a little bit of flavor as to how far we've come. Thanks, Mr.
Okay, thank you very much, Aaron. And I think the overall point you've made, I think, very well, is that we cannot look, especially in ASEAN, we cannot look at international bond markets in a vacuum as sort of this isolated market. When it comes to a corporate issuer, they're trying to raise capital and they have choices, right? They have local markets, they have international markets, they have lending markets, and the individual dynamics of each country can be very different. And in some ways, in ASEAN, it's actually easier for corporates to raise the funds they need, from the local sources. So it's interesting still to see the relative growth in the international market. Okay, now I'll move on to Carla. I've had the pleasure of working with Carla not only on primary markets, but also on primary market practice through ICMA. And I know that you're very, very close to issuers as the head of syndicate of one of the leading banks in Asian capital markets. So perhaps we could ask for your perspectives as well, in some ways from the front lines of distribution, but also your more general observations about the markets as a whole. Carla?
Yeah, absolutely. Thanks, Mushtaq. I think there have been some really great points made, and I guess when I think about what Ling has mentioned, what Aaron has mentioned about the growth of the market, about the greater liquidity available, about the increasing range of issuers that we've seen come to market, what really strikes me is just how much this Asia market has grown, and also how much more resilient, deep, and broad the opportunities it offers issuers are. I think we're very much seeing some of those themes, especially in choppier markets as we've been having. We see a market which over the past couple of years has had to deal with COVID. It's had over the last few weeks to deal with inflation, interest rate issues, geopolitics. And it's a market that is demonstrating a lot of resilience. As Aaron mentions, after a fairly quiet period, a lot of issuers and a lot of investors were kind of waiting out some of the volatility. On the back of an improvement in tone, we've seen a very significant volume of issuance this week. We've had about 6.1 billion across multiple transactions, which has gone extremely well. So to be able to bounce back from some of the swings that we've seen in the market, some of the volatility, I think that really reflects how far Asia has come. I think another element as well that plays into that resilience is some of the pockets of demand that have been offered to issuers through some of these periods. We tend to think quite a bit about kind of the US dollar public market, but we've been extremely active, especially in these trickier markets, printing into some of the niche areas as well. bringing international issuers to some of the local currencies, or into some of the more domestic markets like Formosa. So we've very much seen the market and the investor base able to provide opportunities across multiple spaces. And then finally, I just mentioned that, and I think this has been an interesting point in terms of what Ling and Aaron has both mentioned, that we have seen the market able to adjust and adapt to quite a few developments over the past, several years, and really, to Aaron's point, the last 2 decades. We have seen obviously a huge surge in Chinese issuance, as Brian had mentioned at the beginning. I think when most of us, Aaron certainly, and I started in Asia, we didn't have that much, and now we're fortunate to have 37% of our supply coming from China. So the market has been able to get up to speed, absorb that as a new jurisdiction with a huge range of issuers and sectors. Likewise, we've seen areas that have really taken off, like Indian renewables, just in the last couple of years, with a range of kind of structural backgrounds, et cetera. So I think that the ability of the market to provide that liquidity, but also to get their heads around such a broad range of credits and some really quickly developing sectors, whether it's ESG related, tech related, et cetera, has been, I think, extremely impressive.
Okay, thank you, Carla. And you ended on an interesting note, because we will be speaking a bit more in this panel about sustainability, about ESG and its influence on the markets, as well as tech with some of the speakers to come. And I think it's actually quite, quite encouraging to hear from both you and Aaron about the very recent resilience of the market. I have to admit that when we were speaking about this and planning this this virtual event, even a few weeks ago, markets were extremely uncertain in Asia and, of course, still across the world. And actually, it's a bit of a surprise to me, and an almost pleasant surprise, that at least the Asian markets have started to bounce back this week. So it shows quite immediate resilience in the face of global instability. Okay, well, let me shift gears a little bit now. We've been talking about the primary markets mostly on this panel. Talk a little bit about the secondary markets. And again, obviously, the markets are not, international bond markets are not in a vacuum. You have to think about secondary markets. You have to think about liquidity, even when you're issuing in primary markets. And we have a great expert on the secondary markets. You see a lot of the action, you see a lot of the data, you really think deeply about the trends. And we're very honored to have you here on the panel, Riyad. So let me start out by asking you, in cross-border secondary markets in Asia, what are the main trends that you've been seeing recently in Asia? Primarily, we're concerned about liquidity here at ICMA, but also, what are the drivers of that liquidity in terms of technology, infrastructure, price discovery, and execution?
Yeah, thank you very much, Mushtaq, and thanks ICMA for having me. Look, I think, as you mentioned, secondary, bond markets don't operate in a vacuum, and everything that Ling and Aaron and Carla mentioned, those are, all, significantly contribute towards, secondary market liquidity, right? And probably the main attribute is just the sheer size of the issuance that we've seen over the last, decade or longer. And naturally, if you think about issuance as kind of the supply side, obviously there's buyers on the other side who are buying these bonds, right? So clearly there's a lot of demand for these things, and that kind of largely determines kind of liquidity in the space. If we think about market structure more generally, in terms of kind of the ecosystem or the kinds of participants that are there, I think the signs are really, really encouraging, right? So if you think about Asia credit, you have the international asset managers, and that's a trend, again, I would say in the last 5 to 7 years, we've really seen it accelerate in that they are setting up trading desks more and more in Singapore and Hong Kong to be able to trade the Asia credit markets, right? Historically, some of them might have been trading out of New York or Boston or London, and where the liquidity might not have been as good. So clearly there's enough interest in these bond markets for them to set up offices and trading desks in Asia. So that's clearly a trend. In addition to that, even if I look at kind of the international banks, obviously have been a big market making or just generally big participant in the markets. But in addition to the international banks, you also see obviously big Chinese banks. And in addition to the big Chinese banks, you also see a lot of regional banks, right? And not just the Chinese regional banks, but other Asia regional banks who are also increasingly in the market, both as kind of price makers, so market makers, as well as price takers. And then outside of that, you have other long-only investors like insurance companies, like central banks, and then you have other participants like hedge funds, like private banks, family offices. So if you think about all these kind of investor kind of segments, that's very robust and very, very diverse, right? And when you have this kind of mix, clearly it will generally lend itself to more activity. Andy mentioned earlier, certainly the advent or the introduction of more technology has been also a huge contributing factor. I mean, maybe I'll make a kind of a straightforward example. If you think about the traditional model, right, of the buy side being kind of liquidity takers or price takers, they are the ones that, and the sell side as price makers. Oftentimes liquidity would be thought of as only to be provided by the sell side, right? But what technology, not to put in a market access plug, but what technology has allowed you to do is to effectively reach out to all these other pockets of liquidity, which historically might have been kind of trapped, right? So if you're a large asset manager, you might own a lot of Asia credit that some other buyer might need somewhere, or the dealer might need somewhere to cover shorts, or they're asked to buy the bonds. But now even the buy side via technology, there are things out there in the marketplace like all-to-all trading, what we call open trading on our platform, which really allow both the buy side and the sell side to provide liquidity. So those things without technologies just generally would have been very, very difficult to achieve. And certainly we can talk more about it as we go along. It's really difficult to say, that a credit market is, liquid or not liquid. I think it really, really depends on which markets we're talking about. So if you think about, obviously, some of the other folks have mentioned that in the China high yield sector have obviously going through a bit of turbulence. So whenever you have a market that's going through some turbulence, you can have, more volatility, and sometimes more volatility can be good for liquidity. But of course, there's a threshold. If it becomes, too volatile, then you could see a drop off in liquidity. So we have seen that cycle kind of the China high yield market going through it. But on the other hand, you look at more issuance, and Aaron mentioned about the issuances. You had issuances out of some of the particularly like even some of the sovereigns like Indon and the Philippines and so on. Really, really good liquidity on those markets. So you kind of have to look at which sub segment of the market we're talking about. So that's really, really important. I can pause there, but each of these segments, we can certainly talk about electronic trading a bit more. We can talk about transparency, but maybe I can make a small pause there, and we can come back to it.
Sure, thanks, Riyad. And I think there's a lot to go into, and I hope we have a bit more time for that. But before we get to Julian, we'll get to Julian. Andy, I wanted to ask you if you had any reactions to Riyad's analysis, in particular, based on the research that you've done for the paper more broadly, as well as your experiences in Europe. How would you compare sort of the global experience to that in Asia, and how do you view Riyad's observations about sectors and the entrance of new participants in the secondary markets?
I think the interviews would corroborate very much Riyad's comments. I think definitely, I can't remember when we did our first study on the Asia corporate bond market. It was a few years ago, but we're definitely seeing
2018, I think.
Yeah, and but in that short space, we're definitely getting the impression that there is more uptake of e-trading protocols. To Riyad's point, it's not purely RFQ anymore, that we are seeing more all-to-all trading. And again, it'd be good to get Riyad's opinion on this. It does get the sense, however, that much of it is, whilst it does open up pockets of liquidity, much of this trend is being driven by efficiency gains. And for instance, most of the volumes on trading platforms tend to be the smaller, more liquid trades, whereas the larger, less liquid, and again, we see a very similar pattern in Europe, the larger, less liquid trades tend to be negotiated bilaterally, whether that's voice or chat, and then potentially put through the platform. So it'd be good to get your perspective on that. And something else, you just mentioned liquidity. Transparency. And in Europe, we're having lots of debates about how transparent markets are or aren't. What we found in talking to the Asia market participants is that everyone's pretty okay with the transparency. They think it's fairly good, and that the various data providers do a great job. But anyway, it'd be great to get your take on those two points.
Yeah, thanks, Andy. Look, all great points. I mean, I guess just to kind of address them in the same order. Yeah, if you look at, and you know, we have a lot of data that we can provide you guys. If you look at the uptake of electronic trading in Asia, those numbers are growing, very, very significantly, right? So if I look at just our platform, I believe in 2020 our volumes were up something like 70%. Last year was another 40% odd above, the previous year. This year we're expecting to see more and more. So I would say, yes, we are kind of in that continuum of, if you go back even 3 years, it would be the very, very tiny trades that would trade on electronic platforms. But as every year, every month even, we see that, more and more investors are more comfortable trading bigger sizes on the platform. And to be honest, some of it is entirely behavioral, right? So if you're a trader, you've been trading the markets for 10, 20 years, you might have a preference around how you need to trade. One of the things that we see is that when the traders, particularly the buy-side traders, when they allow themselves to experiment a little bit more and to see, can they get bigger sizes done? Very often, more often than not, you think that they can. Now, of course, I'm not saying that, if you trade something in 1 million versus you trade something in, 20 million or 30 million, the liquidity is going to be exactly the same. That's not the case. But certainly the sizes are increasing. And there's an interesting parallel I can probably draw between the credit markets and the Asia local currency markets, right? So, I spend a lot of time in the Asia, local currency bond markets. And I remember, I don't know, maybe 6-7 years ago, right? When Indonesia or Thailand or Malaysian local currency bond markets used to trade, there were these smaller sizes. And then over time, partly because of technology, partly because just, I guess a greater appreciation of the liquidity that's out there, those sizes have increased, multiple folds, very, very significant size, to the point where I would say in local markets in Asia, there's probably just about no size that you can't trade electronically. So I would expect to see something similar over time happen in the credit markets as well. Now, within credit, if you think about, Asia IG. Now, in Asia IG, given day, you might be able to get 20 dealers to make your price, right? 20 market makers to make your price. Very deep market, lots of market makers. You can get size done, no problem, right? But on the high yield market, you probably don't have as many participants, right? So you probably have, I don't know, a handful, 6 or 7 maybe international dealers who are probably stronger than others. And obviously when you have, such a concentration, you're really kind of subject to the risk appetite of those banks or the balance sheet constraints of those banks. All these things kind of factor into the sizes that you can trade. So those are, those are obviously real factors. But over time, I would expect to see the market as it matures, as we have seen in Europe, as we have seen in the United States, that the sizes do increase. To your other point about transparency, look, I think liquidity and transparency go very much hand in hand. And I might take the other side of that the transparency is really great in Asia. I think if you compare this region to, for example, in the United States, you have something called TRACE, right? So all U.S. investment grade trades will get reported to TRACE. So on any given day, like when I come into the office in the morning, I can look at and say, last night, $30 billion of US IG got traded. Similarly, in the UK, you have tracks. So you have, and it's very, very similar. So, trades done by European dealers get reported on tracks. And why that's important is, one, it allows you to really size up the market, right? So if I asked the panelists here, or even myself, you tell me, well, how much does Asian credit trade daily? I don't think you will get one answer. You will get different answers because there is no central place where you can go and find how much has this bond traded. So what you can do is go to different data sources. So market access, tracks, other data sources, and you can kind of piecemeal together and figure out, Asia credit maybe trades between $4 to $8 billion a day. And then you can think about, okay, which segments trade, when do they trade? Is it mostly in Asia, mostly in Europe? So I think while there is some degree of transparency in the market, I think that, as a region, we could definitely do a lot more towards getting more transparency. And the reason transparency is important, and why it's important ultimately to both investors and issuers, well, maybe more the issuers, is that, transparency ultimately leads to kind of trust. People know what's happening, how much is trading, where they're trading. And those kind of things generally lead to more liquidity. And more liquidity generally leads to lower yields, is what we've seen in other parts of the world. And generally, if you have lower yields, if I'm an issuer, if I'm a sovereign or I'm a corporate, I want to issue bonds, I want to issue them in lower yields because my cost of funding is lower. So there are very significant or structural implications for having greater transparency.
Okay, thank you, Riyad. A lot of interesting points in there. I mean, two that I found especially interesting. One is about local currency markets, and I hope we get a little bit of time to go back into that because I think you made a very interesting point about efficiencies in electronic trading in local currency markets as opposed to cross-border markets, which I think is quite counterintuitive, to me at least. And then secondly, well, we could always get into a bigger philosophical discussion, and I know Andy and I have on liquidity and transparency. Maybe we'll get to that. I'm not sure if we have enough scope, but I'm definitely interested in that. But sorry, I'm going to move on to Julian now. And Julian, thank you for your patience. So Julian, you've been a great partner with ICMA for many years, and your career has taken you in different directions. So you've really seen the markets from quite a few different angles. Of course, you were running Bond Connect just a couple of years ago, and now you have a role that's more focused on innovation. So if you could just share some of your perspectives from both those roles and any others you've had in the market as well. And in particular, what are you seeing right now? I mean, what are you seeing as the innovations, since that is your current role?
Okay, thank you. I mean, I've taken so much notes of what the previous panelists talked about, and especially Riyad. Thank you for everything. I mean, I'm learning a lot from you. Now, I'll start with Bond Connect. Obviously, it's been obviously an amazing part of since September, the launch of Southbound. We've seen a lot of innovation continuing in the access into China. And with the geopolitical situation, even more interest in parking into RMB assets. So Southbound definitely, as Daryl mentioned, a big breakthrough. We've seen some very exciting issuances on the back of Southbound. One was the Shenzhen government green bond. There was the first, national regional government that actually issued dim sum bonds, and so there's an overall revival of the offshore RMB market through the Southbound effort. Northbound has been exploding, reached 70 billion in a single day in Jan, now trading roughly around 40 billion RMB daily. I mean, it's become a mainstream business and a very, very attractive. And as I mentioned, RMB assets have remained super attractive to the market despite hoops and complicated situation. I've seen a lot of innovation from market players rather than immediately from the infrastructure guys around the RMB bond collateralization and usage of RMB bonds in derivatives and leveraged investments. And asset-backed notes and so on and so forth. There's been a lot of things done by our market players in the Bond Connect scheme as well that have raised also activity and improved overall access. That's one thing. So now if I move into obviously new topics for me, which is around more digitization. Clearly, I see trends in digitization that are definitely going to be impacting the market. First of all, a lot of people are looking at tokenization of existing fixed income securities. Why do we do that? In order to manage size, in order to manage access, in order to manage also payments and much faster turnaround time in overall access to the assets. There's been obviously a lot of discussions here in Hong Kong in particular. We've worked on Genesis 1.0 with the BIS and the HKMA and the issuance of these green bond, native green STOs directed towards retail investors here in Hong Kong. There was a lot of great ideas from all the different people in this proof of concept work. We were looking at how retail investors in Hong Kong could actually offset their carbon footprint by investing in this type of paper. Extremely exciting type of initiatives that I feel are going to probably realize and become more and more mainstream. And I'll come back to that. Obviously, all the developments around payments and CBDC, central bank digital currencies, will also have an impact on the overall digitization of the fixed income markets. And CBDC are going to be huge in Asia, probably even bigger in Asia than in the rest of the world. So how is that going to be impacting our settlement times, our clearing times, and overall our cross-border payments and even FX, which is obviously in Asia still a very big topic. I'm not going to insist on that, but clearly we have so many currencies here in Asia compared to other zones where that's really things that we can definitely deal with all those wholesale CBDC efforts. Now, there's been also a lot of work in primary markets. I think many initiatives across the region, some in Singapore, some in Hong Kong, develop more and more digitized primary market platforms, sometimes cutting down intermediaries, giving more access to end investors directly. This is going to become a trend, and even as an exchange, I can definitely say that we even in equity markets we see the same trend is also going to become more and more pregnant because we want to reach out to the end investor more and more and cut the intermediaries and cut the time of execution and improve efficiency and reduce costs. This is going to become a trend in any kind of capital markets. And obviously, fixed income is not going to get out of it. Now, ESG, obviously, it's, as you mentioned, a topic which is very dear to your heart and very dear to my heart as well. It's been exploding in Greater China. I mean, exploding in Hong Kong, thanks in particular to the government efforts, the HKMA grant scheme. I mean, we've moved from less to $5 billion of green bonds in Hong Kong to more than 25 billion just last year, and we're on track to exploding this again this year. I mean, it's going to be only the beginning, in my view. It's no longer going to be about green bonds. It's going to be about bonds that are not green bonds that are going to become a minority of everything that happens, especially around Greater China, probably in other regions as well, as you've raised it. There's been impact of ESG ratings. We've talked to some issuers that are now looking at their ESG rating very actively. So they are very keen on seeing how their ESG rating is eventually going to be impacting their borrowing costs. And more banks are looking at this in order to reduce borrowing costs. And obviously, it's the next step is going to be about how do we eventually finance a lot of the new carbon reduction projects and all of these initiatives around mitigation outcome instrument type of bonds. Is that the new future green bond market that we want to see globally? How are we going to be monitoring the impact of all those green and not only green impact finance, social, sustainable finance paper, and how are we going to be monitoring all of that using new technology and making sure that when people invest or when people take a share in an investment such as a fixed income securities, the outcome is at the same level as what they expect. So I'd say we are very much only at the beginning. I know we could probably talk about carbon reduction targets and how that's going to be just driving so much new bond issuances for renewable energy, for carbon capture. This is going to become such a big thing in Asia. I mean, we've got 47% of the entire carbon greenhouse gas that is generated out of Asia. It's pretty natural that this is going to be a central problem here, and a central solution, in my view, is going to be fixed income markets.
Okay, thank you so much, Julian. I think some of the points you're raising about digitization of bonds are super interesting, and I do want to get back to you because I want to sort of unpack, what is real versus what is just incremental, right? But before we do that, you made a good segue into ESG and sustainability, and I think quite fortunately, this notion of sustainability has gone from a very niche part of the markets when I first started working on green bonds, back in 2014, to being something that pervades the market and that everyone is working on. And fortunately, I think everyone on this panel now has a view and has direct experience with sustainability. So I'd like to hear the different perspectives as well, and how people are seeing this in the context of the international bond markets. So perhaps, Ms. Chen, I'll start with you. If you could just give us your perspectives currently on sustainable bond markets. I know you touched upon it in your introduction. What are the drivers of growth from your perspective? What are the reasons that issuers are going ahead with sustainable finance? Your own clients, why are investors interested in it as well from an agent perspective? And how might these reasons be either similar or different from issuers and investors in other regions?
Yes. So the first driver for the growth of ESG bond market is of course China counts a lot of portion on the offshore ESG bond market. In 2021, China announced its aggressive plans to reach peak emission by 2030 and achieve carbon neutrality by 2060. So this national strategy involves investment of green projects, including renewable energy, nuclear energy, and electric car, etc. So the above strategy is a mandatory requirement for firms, which is a strong motivation to pursue green investment and financing. So a significant proportion of investment will take place in next few years as the country tries to meet the 2030 goal. So rising demand of ESG bond may be a source of funding for these projects. Some energy analysts have estimated that China may need to spend as much as 60.4 trillion yuan, about 6 times the size of the current green bond market, till 2060. So that is from the perspective of China that they have set out an aggressive path to carbon neutrality that would require significant funding. So we expect this to be raised by green fund issuance in the domestic and international market. So which may attract the rising pool of investors looking into this market segment. So this may power the offshore green financing market to a massive growth. So from investors' demand, ESG is also recognized by the international investor community as an established direction. So international investors are increasingly active in sustainable finance. Many asset managers have begun to introduce this kind of funds. Some investors, including insurance company, have begun to report sustainability metrics, declare net zero targets, or introduce exclusion policies for carbon-intensive industries. So also, and many banks also now have bank-level sustainability strategies in place to reduce the overall emission related to their portfolios. So this may in turn affect their policies towards selling and underwriting bonds, both for sustainable finance or in high carbon assets. So many asset managers has recruited talents to build up their ESG teams to examine company level ESG performance among other ESG parameters to overall to do an overall credit analysis. So that is from first, national policy is from the point of view of our issuer, and then another driver is investor demand. Thank you.
Okay, thank you very much. And I just want to reiterate one point that you made, which I think is super important and maybe quite underappreciated, which is the seriousness of the national policies towards carbon neutrality and net zero. I mean, these are not just high-level statements. I mean, these have been translated into very specific goals in terms of the transformation of the energy and manufacturing sectors. And the goals are extremely ambitious, not just for 2030, but globally. And so you can think about, how feasible it is to meet these goals. But what's clear is that the goals exist and that they're going to have to be financed, and they're not going away. So I think this creates tremendous opportunity and a real support from the top down, really. Just one other point I'd like to make, just kind of historically, which is that I think we're quite used today to sustainability regulation. But if you went back to, say, 2015 or 2016, when I would speak with ICMA members, the vast majority of them, especially outside of Asia, would say that the market should just regulate itself, right? The green bond markets will grow naturally if investors want and issuers want to do it. And we saw that China was really the first to come out with official sector support for the markets, which really boosted issuance. And other countries in Asia have done the same. I've been particularly fortunate to work with some of the ASEAN countries as well in formulating the ASEAN green bond standards and ASEAN social bond standards. And I think that has actually quite helped to grow the market as well. So I'll segue over to you, Aaron. I have been mainly involved at kind of the official sector level from ICMA's perspective, but what have you seen from the actual issuer's perspective and from the end investor's perspective? How have their perspectives changed towards sustainable finance, and why do you think that has changed over the last few years?
When anything new comes up, I'm a DCM guy, so I go up to the issuer and say, "Oh, this is this new thing coming up." And you got to do it, because you want to be the first, and then everyone comes back and says, "All right, so how much is it going to save me?" And then you're like, then you're moonwalking, like, no, it doesn't really save you money, but you get to do this, and then you're dancing around the topic. So that kind of recurs every 2-3 years when something new comes up. Now, that's obviously no different anywhere, but I think certainly in ASEAN, where issuers by default already have a lot of choice in terms of how to get money, it becomes even more difficult. But we have seen that attitude soften up and change over the course of the past few years, and where it's not just about trying to do the right thing in a sense, but the fact that they're hearing this from multiple angles. And not only from the issuer side or the banks, but also from investors, demanding to see, even if it's not a labeled green or sustainable bond, what is your ESG plan as a company becomes a very prominent question in roadshows these days. So all of these, little by little movements around it is really kind of coming around to. I guess what Julien was mentioning, that it might end up being the majority of what we do, and as Mushtaka, you mentioned it too, that it's not about green versus non-green, but it's about it's like, if you're not green or you're not sustainable, can you issue? Could be the question that we eventually have to solve for, right? So. I think people are understanding that, and certainly in the various countries within ASEAN, I see much more enthusiasm there. Now, in the local currency markets, though, we haven't seen that translate yet. Now, obviously, from a green bond perspective, China and India have been, in the local currency markets, have been very, very much ahead of the rest of Asia. But in the local currency markets, I think baby steps are being made. But not so much yet, and I think that's something that would have to try and understand a little bit better. Although efforts are being made, certainly, for example, in Singapore, with a very big drive by the government and the government related institutions looking to do green. We were involved in the first ever green bond by HDB not too long ago in Sing dollars. So these are things that I think are very meaningful steps. And again, just for the sake of people who don't know, HDB is the biggest single issuer in the Singapore dollar bond markets and does about 20-25% of all issuance every year on year. So them taking that step is obviously very, very meaningful and something to look forward to.
Okay, thank you very much, Aaron. I'd also like to ask Carla about this as well, because Carla, you have a unique role where I would say you're involved in a lot of the conversations between Asian issuers, Chinese issuers, and international investors and international even regulators and colleagues. So tell us a little bit about those conversations. How have you seen that interaction happen? Different perspectives on sustainability from different regions, and your perspectives on the growth of ESG here in Asia and where that's going.
Yeah, absolutely. I think we've had an interesting journey in ESG in terms of kind of how this market has first developed and then how it has progressed. And I think it's fair to say that Europe has been probably the earliest adopter and in kind of the very earliest stages, and then we've seen the baton really picked up by places like China, India, and more broadly in Asia. I think probably what we've seen over the past number of years is really a market, whether in Europe or in Asia, that really starts out as something that issuers want to do. I think to Aaron's point, it's a way for them in the early stages to make a statement about their corporate priorities, to make a statement about their values, and they kind of issue those first green bonds without necessarily a clear existing, ESG motivated investor base. And, I've said sort of since the early days, build it and they will come. So you have to have the supply, and then the investors have the assets that they need to set up more dedicated funds, to do more dedicated work. And that has dovetailed very nicely with various political priorities that are going on all over the world, especially, here in Asia with some great leadership from the countries in the region. So I think, when we think about the growth of this market and sort of the path that it's taken, the issuers have kind of taken that lead, and the investors have really met that, I think, with an increasing amount of work, an increasing amount of focus, an increasing amount of sophistication. And, as Aaron mentioned, there's a lot of philosophical questions. Is this an ESG bond? Are you an ESG issuer? Going into some very, very high level questions. Is this an asset that I feel comfortable investing in? And that's something that we're seeing more and more of. I guess when I think about, specifically the ESG market, what is it now offering? And, I think it still very much offers those opportunities to issuers to make a statement, to do something public that demonstrates their values and the work that they're doing in other areas of sustainability within their organizations. But it also is representing a greater and greater opportunity to achieve, specific debt capital markets commercial benefits. And especially in choppier markets where liquidity is a little bit scarcer, investors are that little bit more selective in terms of how they deploy. I think we're very much seeing that, come into the fore. That doing an ESG transaction is opening up those additional pockets. So it's reducing execution risk in difficult conditions, it's increasing size, it's improving pricing. When I look at what the European market has done, and they've generally kind of set a good sort of framework and sort of template that has proved to be prescient for a lot of other regions. We very much see that taking place. So when we look back at some of our data from 2021 in the Euro market, we see oversubscription consistently higher on ESG-related bonds, 3.3 times rather than 2.9 times, and new issue concessions also lower, an average last year of 2 basis points on ESG-related, 4 basis points on conventional. So we're definitely seeing that coming through, and even in Asia, from the research that's been done, does show better kind of resilience in secondary markets for these ESG-related bonds. So it has been, I think, a really exciting time in the market to really see this take off and become a real driver from both the issuer side and the investor side. Whether we're talking about international names or we're talking about homegrown names, it's become relevant really for all of us.
Indeed, and one big shift I've seen, just in the last couple of years, is that the technicals for green and sustainable bonds have started to diverge a bit from those of vanilla bonds. You might think they should be exactly the same credit, generally the same documentation, same covenant package, right? So why should they be trading differently? But in fact, they are, both in terms of pricing and in terms of secondary liquidity, and even in terms of kind of resilience in market volatility. So this is pretty nascent research, but very, very interesting, and we're seeing almost the divergence of class now. Okay, we are getting an audience question. So if there are those of you in the audience who would like to ask questions, please do.
Sorry,
yeah, go ahead, Aaron.
Just to round up this topic. Sure. Obviously, I know we could spend hours on this, but
go ahead.
I mean, like literally this week when we kind of reopened markets with the Republic of the Philippines triple tranche transaction, the 25-year transaction was an ESG, a sustainable bond, and that's the one that tightened the most from initial price guidance to final price guidance. And it was, again, the largest transaction, tranche as well. And so I think these are not just random kind of examples, but empirical evidence that, that shift of trend is something that we're seeing. Now, one thing that I do want to add to that as well is that I think not only are we, obviously use of proceed bonds, which are green bonds, sustainable bonds, social bonds, etc., are much more easier to do in a sense. But I think there's probably more to look forward to for sustainability-linked bonds, where there's a clear KPI that not just the bond itself, but as an organization, as an issuer, I'm committing to certain things. And I think these are some of the trends that I'm hoping to see more of from Asia, because I think that's much more holistic rather than just a particular project that just happens to be green.
Thanks. Okay, thank you. And a shameless plug, the sustainability linked bond principles, as well as a lot of information about how to issue them and market information is on our website. So ICMA is quite focused on this. Now, if there's anyone in the audience who has any questions for us, we do have a little bit of time. We might go over just for a few more minutes to allow us to address some of the remaining issues. But we have from the audience a very traditional technical market development question, which I'll pose to all of the panelists. I'm not sure who the right person would be. What can be done to help revive the Asia single name CDS market? We haven't talked much about hedging, but that's absolutely crucial to the secondary market, certainly. So does anyone on the panel, including Andy, would like to address this?
I can take a crack at it, Mushtaq. I mean,
please.
We don't trade CDS on market access at the moment. But what I would say is, if you think about the credit markets relative to, let's say, the Asia local currency government bond markets, right? So if we kind of decouple, credit markets, if you buy a credit bond, you have credit risk. So this is where you're taking a risk to the issuer that that the issuer will not default, that you get your money back, or depending on the riskiness of the issuer, you want to get paid for the risk that you take. So you have higher yields or lower yields. So you have credit risk, you have duration risk. So, how long of a bond do you want to issue? We've seen in your paper, it says, the sweet spot is kind of in the shorter to intermediate. So let's call it 3 to 5 year type. And then you have interest rate risk, right? Because a lot of these bonds trade as a spread to US treasuries, right? Interest rate risk, yeah, you can trade US treasury markets, there's futures, there's cash markets, you can hedge that. Duration risk, yeah, you can kind of choose what you want to do, how much duration risk you want to do. The credit risk part is really where the single name CDS comes in, right? And I think, that's, remains, I guess one of the missing pieces to the puzzle to create even more liquidity. I think, since the GFC, certainly, a number of the market participants that used to trade CDS, that's gone down. And that's gone down partly also, because a lot of the investor base have reduced their use of single name CDSs and how they want to hedge it. So I think it is a little bit of a chicken and egg thing. The buy side might say, well, there's not enough. Sell side, making markets, and the sell side might say, well, I'm not going to start a CDS trading desk if there's not enough interest from the buy side. But what we do see is that it seems that at least certainly in Singapore and Hong Kong, there are more banks who are starting to trade the single CDS. Maybe they start with index, but over time trade the CDS, the single name CDS markets a bit more. Also, as more and more of these banks start trading them, you also have a deeper interbank liquidity, right? So if I'm a bank and I trade CDS, I also need kind of the other side of the risk, right? Or how do I get out of my risk? I need other participants who make me markets as well. So I think as more and more people do it, more participants come into the market, they can trade amongst each other, that creates more liquidity. And of course, when they create more liquidity, if I'm a buy-side investor, credit investor, naturally I would want to think about, well, I have exposure to this segment. I like the bonds, but there are all these tail risks, things can happen. Maybe I should go and buy some, CDS as a protection. And also with more liquidity, naturally you would expect, right now, maybe it's very expensive, right? Maybe the bid offers are too wide. So maybe your hedging cost is so expensive that you don't want to hedge, right? So as more participants come into the market, bid offers come in, hedging costs go down, and then they act really as hedges. Because if you're a credit investor, you hedge because you kind of, it might be like a necessary evil. You hedge because you need to, but your core position is still that you want to take a view on the credit, right? So unlike, for example, local currency bond markets, like, government bond markets, you can hedge the FX risk, you can hedge the interest rate risk. You don't have a whole lot of counterparty risk, generally speaking. Again, generally speaking, because, these are governments issuing the bonds and they tend not to default, at least most parts of the world. So I would say those are the things. And I do think that in the coming years, as you see more banks setting up the CDS trading desks again, that we should start to see a single name CDS market come back.
Okay, thank you. So a lot of it, if I'm understanding you correctly and maybe very crudely summarizing, a lot of it just depends on commercial interest. And, it's a bit of a chicken and egg problem. When people can, do good business on this, and it's in demand enough, then it will happen. Okay, well, I'm afraid
100%.
we're almost out of time. We have one final audience question, which I'd like to address to Julien, because I know you're involved in innovation. You're involved at the intersection between China and the rest of the world's markets as well. So the question from the audience, Julien, is what more can be done, both from policy and market points of view, to help develop the Chinese onshore ESG and green bond market?
I can answer super quickly. Common ground taxonomy.
Okay, very concise. Tell us a little bit more about that in 60 seconds.
No, but to be extremely serious, there with the other major entities here in Hong Kong, with the SFC, with the HKMA, and the government, we're working on many aspects of the internationalization and especially of the ESG matrix and taxonomy. So definitely especially the bridging of EU taxonomy with China taxonomy is something which we're spending a lot of time with the SFC, a lot of time with the MA, and hopefully there will be results out of that. So I think this approach to a common ground taxonomy, especially coming out of all three major regulators here out of Hong Kong, should be really driving a lot of these impacts and a lot of these changes. But to be honest, despite that, we have seen so much happening and so much innovation again. So once we have done that, I think then it's going to be about bridging more commercial interests out of especially the Western world with the Chinese world, which currently is probably hindered by this lack of common ground taxonomy.
Okay, great. Well, that's a mixed, but I think ultimately hopeful point of view. And I think that's a good way to wrap up this panel. So thank you all very, very much for your insights. I learned a lot in the last hour, and I hope you and the audience did as well. Again, if you have further questions on our research, please feel free to reach out to us at ICMA. We're just delighted to hear your feedback and your questions and your ideas. Thank you again for our keynote speakers, Mr. Chan from HKMA, and of course, our CEO, Brian Pascoe from ICMA. Really appreciate your time and your expertise. Thank you.